Time to resume. My name is Benoît Mojon. I'm the head of economic analysis at the Bank for International Settlements in Basel. I actually have a long career in central banking. I began in this building on the 2nd of November 1998. I remember it as if it was yesterday. My badge number was 452. So for those who joined the ECB since, you know what it can mean. And I've been also a ECB Monetary Policy Committee member for the Banque de France from 2011 to 2018. So it's a great honor for me to be here today and to moderate this panel with our three distinguished speakers. To my extreme right, Beth Ramsden, Deputy Governor of the Bank of England since 2017, after rising through the ranks at the Treasury. Given where we are today, I'd like to recall that Dave knows the euro area quite well, given that he led the Treasury's work on whether the UK should join the euro, but that's more than 2 decades ago. And in my experience at the BIS, I had the privilege to witness Dave's interventions in the BIS CGFS, where his interventions are among the most passionate and engaged, and it's always great to see the energy that he brings to the committee. Next, to his left is Elizabeth Hammack, who is the president and CEO of the Federal Reserve of Cleveland. She has been a staff and then a partner at Goldman Sachs. And as a member of the FOMC, President Hammack is experiencing an elevated level of media, social media, and societal attention at the current juncture. This being said, she animates the current debate on US monetary policy in her speeches, where she asks very profound and important questions on the level of our star at the current juncture and what should be the size of the Federal Reserve balance sheet. Our third speaker, Philip Lane, is the chief economist of the ECB and former governor of the Central Bank of Ireland. He's playing at home, so he doesn't need an introduction. So we will proceed in 3 rounds. First, the outlook for inflation. Then second round, what you see, you members of the panel see as the most relevant conceptual challenges for monetary policy decisions. And then we will venture into more specific issues for each of you in your specific jurisdictions. In a recent speech President Hammack gave in June, she stated, "My job as a policymaker is to separate the signal from the noise in financial markets." I have no doubt that today, that's very much what this panel is about. We'll need this insight, and I'm sure that you guys will convey a lot of it. So let's begin with the outlook on inflation. With 3 very contrasted situations across the euro area, the US, and the UK. And we'll begin with President Hammack. Then Philip will take the floor, and then Dave. President Hammack, the floor is yours.
Great, thank you so much. Appreciate being here and appreciate the opportunity to co-host with our partners at the ECB. This is really a great pleasure that we spend time on this. And as the committee is focused on inflation, we can start there because there's obviously a lot going on in that space. When I step back and think about where we are in the US right now, when I look at inflation, I think that we are too high. We've been missing on our mandate for 4.5 years. And when I look at the trend is in the wrong direction. Last September, when the Fed embarked on reducing rates for the first time, we had inflation that was lower than where we are today. And the trend was headed downwards. We had good line of sight that we expected inflation was going to continue to move towards our 2% objective after a long period of being above it. Over the past year, inflation has largely moved sideways. Some components have actually moved up. Obviously, tariffs are a big part of the story, and there's a lot of different perspectives on what that might mean and how tariffs might play out. But part of the inflation story that seems to me to be a little more concerning is that the services part of inflation has been remaining elevated. So when you look at some of the sub-measures, when you look at core services ex housing, that measure has been closer to 3.5% and has actually ticked up in the past couple of months. And it's harder for me to unpack that and attribute that to some of the tariff impacts that we're seeing. So I think it's important to remember that we do have a 2% objective. It's critically important that we achieve that 2% objective. And in order to do so, we need to balance a number of factors. For the US, unlike other central banks around the world, we do have two objectives. So we have the inflation objective, which we talked about, and our goal there is 2%. But we also have a maximum employment objective. And so we have to balance the two things. Right now is a particularly challenging time for monetary policy in the US because we're being challenged on both sides of our mandates. So in addition to the inflation side, which has been above target for 4.5 years, and from my forecast, probably won't get back to target for another 1 to 2 years. I think end of 27 is what I have in my forecast for when we'll get back to target. We are starting to see some emerging signs of fragility in the labor market. Largely that's come through in the headline payroll numbers that we've seen. Now, other indicators, other measures of the labor market are reasonably stable. If I look at the unemployment rate, it's ticked up slightly to 4.3%, but that's right around my estimate of maximum employment. And it's been reasonably stable between 4 and 4.3% over the past 12 to 18 months. The headline number on payrolls dropped pretty sharply over the past couple months, and we have had another year of significant downward revisions in the QCEW study. And so it is showing that there's something changing in the labor market. Now, that could be on the demand side. It could also be on the supply side, given the sharp changes that we've seen in the immigration picture in the US. Other indicators, whether it's the unemployment rate, whether it's the vacancies to unemployed ratio, whether it's the weekly jobless claims number that come out, would give you better evidence of balance. Those are more indicative of a market that's reasonably in balance. Again, it's this low hiring, low firing environment that we've been in for quite some time. When I'm out in the district talking to businesses, what I hear from them is that they took a long time to bring their workforce together. It was very difficult to find the talent they wanted through the pandemic, and they're loath to let people go. So when we look at things in the US, there's an indicator, a notice that companies need to file ahead of mass layoffs called a WARN notice. When we track those, which we do at the Cleveland Fed, we're not seeing that trending downwards. The thing that concerns me the most right now is inflation expectations and making sure that inflation expectations remain anchored. As you'll note, the committee reduced rates by 25 basis points at our most recent meeting. The summary of economic projections would have the median, including 2 more rate reductions through the course of this year. I think it's important that in order to be able to support the US economy, we can only do that if inflation expectations remain anchored around our 2% objective. Broadly, I would say they do seem to be anchored, but there are some signs of elevation. If you look at in Cleveland, we run a daily survey of consumer expectations, and that's been trending up pretty steadily. Firm expectations have been a bit more muted. And when you look at other surveys, whether it's Michigan survey or some others, those seem to be reasonably well anchored. Market-based measures of inflation expectations have been reasonably stable, although we are seeing a little bit of elevation there, which is something that I want to watch carefully to see how that continues. So right now, from where I stand, inflation continues to be the bigger concern between the two sides of my mandate. Inflation remains higher than I want it to be. It's headed in the wrong direction. And on the employment side, though we are seeing signs of fragility, we're coming off of a reasonably healthy baseline, and the trend has been very modest at this point. So I need to remain attentive to that. I want to be open-minded about where things may head from here. But right now, when I look at those balance of risks over the future, I think we need to maintain a restrictive stance of policy to ensure that we can bring inflation back to our target.
Thanks a lot. Very, very clear. Can we now ask you, Philippe, the situation in the euro area?
So first of all, let me say it's a pleasure to be able to participate this joint collaboration between the ECB and the Cleveland Fed. I've participated in a number of these over the years. I think it's a really successful conference of this dedicated focus on inflation. And I will also focus on inflation in these remarks. So let me emphasize that in the end, even though inflation is around 2% now, even though in our latest staff projections, inflation this year will be very close to 2%, it's very important to look underneath the hood, because where we are now is for this year, the projections have non-energy inflation. So there I'm adding food inflation with core inflation is 2.5. But because energy inflation is minus 1.6, the overall number is around 2. It's a mix of non-energy inflation being still, markedly above target. So what's interesting about the next year or two is the transition. So we have, or the staff have, non-energy inflation going from 2.5 this year to 2.0 next year, and then 1.9 in 27. And that just, by the way, is part of a longer series looking backwards of a pretty elegant, smooth disinflation for non-energy inflation. Whereas for energy inflation, and if you remember, between 21, 22, it went up by 50%. We've had a mild energy deflation since then. And what's happening is we will still have energy deflation next year, but less so. It goes from minus 1.6 this year to minus 1.1 next year. And then it jumps in 27 to plus 2.4. And there is a discussion about the policy sources behind that plus 2.4. Now, I don't really want to get into that, but the bigger point here is the whole history of the euro area has been marked by very big swings in energy prices. And so I think it's kind of, again, interesting analytically to think about. Now, we know it spills over. So energy inflation matters for everything. But of course, energy inflation at 50% matters a lot more than energy inflation plus or minus 1 or 2%. But the question I have come back, I feel like, Beth, I mean, like inflation right now, the non-energy component is not at target. So the question is, why do we think there's more disinflation to come? And essentially, it reflects, number one, our beliefs about the wage disinflation. That we have, it's still the case if you read the monthly flow of data, wage inflation right now remains fairly high. But thanks to the people who organize this conference, we have a wage tracker, which tells us the second half of this year, going into next year, people are signing contracts already with much lower wage growth, nominal wage growth. So I think we have that. And then it's reinforced by the exchange rate appreciation, the energy deflation, and the fact we do have a fairly subdued profile for domestic demand. It's growing, so we're happy that domestic demand is sufficiently resilient that essentially there's no kind of talk about any kind of recession talk, and we have low unemployment. But the fact that we do have this disinflation, another year of disinflation, is important in thinking about the dynamic. Now, the question is the glide path. Are there forces there in the disinflation that mean we don't stop at 2, that we kind of break through 2% and go back to a kind of below target equilibrium? And I think the base case is, again, assuming monetary policy does its job. We should never forget to say, of course, inflation does depend on monetary policy. But assuming monetary policy does its job, having the elegant re-anchoring towards target, I think it's plausible. Number one, inflation expectations, have re-anchored at the target. We do have, I think, solid base foundations for domestic demand to keep on growing. That's partly the monetary easing. The fact we've eased from 4 to 2 is playing a big part in the current momentum in the economy. We will have more fiscal support than we're used to in the last number of years. And with the low unemployment and real incomes growing, it's plausible there's a good foundation for consumption. So I do think we still have a calibration issue. To nail being around 2%, it still requires monetary policy to calibrate correctly. But essentially, it doesn't look like we're going back to the pre-pandemic equilibrium of very low inflation. But neither does it look like, I think, right now, do we have substantial risks of remaining noticeably above the inflation target either. And again, the structure of our economy is different to the US and the UK economy, and maybe especially in terms of the labour market. And for these reasons, I think we do have this kind of assessment of the inflation outlook, which is reasonably benign at this point.
Thanks a lot, Philip. So basically, the trend in wages and real wage you see as one underlying force for the trajectory of inflation. I guess it should depend also in part on where real wages are after being dented, going into very negative numbers during the post-COVID inflation. And this was a very large shock, how long it takes to adjust to a new equilibrium, a point that we can come back to later in the panel. So let's now go to Dave to tell us about the situation in the UK, where inflation is much higher than in either the euro area or the US. And Dave, the floor is yours. I think you have a couple of slides.
I do, but thanks for the earlier introduction, Benoît. In being in this room, I must say I want the audience to know that something I did earlier in my career before the UK's decision on the euro was that I was the economist on the UK presidency team when the UK was president of the EU, when the euro was launched in March 98. So it's very good to be back in the Euro Tower, and thanks to the organisers of the conference and the ECB and Cleveland Fed for inviting me to participate. So yeah, if I could, my first slide is up. To very briefly set the scene, I'm one of the 9 members of the MPC in the UK, and 2 weeks ago or so, we voted by a majority of 7-2 to keep bank rate unchanged at 4%. Think of that as the latest step in a period of gradual and careful easing in policy restraints since August 2024, when we've cut bank rate by 5 times in total, but it's still at a level of 4%, so significantly higher than the official rate in the euro area and very similar to the US. And I think that reduction does reflect the fact that we've had substantial disinflation until recently. But I think it's, as Benoît just highlighted, where the UK is now is in an interesting place. And what we've seen is inflation really rising since this time last year. So that headline inflation is now at 3.8%. And we expect it to increase slightly further, but that will be the peak in the hump of inflation that we've been expecting to see throughout this year. And I think why that's so relevant to this conference, as well as to our outlook, is because there is this key factor which Beth was highlighting around how inflation expectations have responded to that. But at the same time, and although we only have a mandate to get inflation back to the 2% target, we don't have a dual mandate. We have seen the labour market continuing to loosen with wage growth normalising. And I see that as supporting a continuation of the core disinflation process. And that anchors my view on the inflation outlook. And let me just go, I think Phil said we should look under the hood. So let me just look at the component parts of inflation. And this latest hump in inflation, you haven't actually got the headline here. You've just got the various component parts. And there are three key things to draw out, really. The pickup in headline has been caused by energy price falls dropping out of our annual comparison. Headline services disinflation slowing and food prices rising rapidly. Now, the energy price effects in red are interesting, but I wouldn't say they were that relevant to they're orange on there, to the current UK inflation outlook. But I think services and food prices, I'd like to say a little bit more about both of those. And they're also relevant to the research agenda, which we'll come back to later in this session. So services ex rents, shown in yellow, has been stuck pretty close to 5% for the entirety of 2025. Headline services at the moment in the UK are at 4.7%, whereas the euro area services inflation, the comparable figure is 3.1%. So you've got a really significant divergence in what is a very significant share of the UK inflation basket, and typically is much more homegrown in terms of inflation. But beneath that headline services figure, as well as rents, which are now coming off, as you can see in green, indexed and regulated prices have been a major component of the recent price increases. And actually, as have the impacts of government policy, for example, a year ago, putting up national insurance contributions for employers, which is our main employment tax. So if you assume that these various regulated and other price rises are not repeated this year, which I think is a fair assumption, we should see headline services inflation starting to come down much more materially, and that will be supported by the fact that underlying services inflation continues, when you look at higher frequency measures, to be on a disinflationary path. Food inflation is another story, and that's in blue. That's risen rapidly, and it's projected to reach 5.6% by the end of this year. Now, a lot of this does reflect global factors in a few food categories, as my colleague Swati Dhingra has been drawing attention to. But it's also important to really note the salience of food prices for household inflation expectations. And it seems to be the case from research we've been doing that I'll come back to, that inflation expectations have become more sensitive to food price inflation rises following the double-digit inflation of 2022 and 2023. And, you know, we are at the same time as this pickup in food, seeing a pickup of inflation expectations for the whole economy, particularly on the household side, and that's adding weight to that argument. That's looking beyond, that's looking at the short term for what's caused this hump. But as I've said, I do remain confident that we're going to get inflation back to target with the current setting of inflation, which is of interest rates, which are still in restrictive territory, and also given the market expectations that we condition our forecast on. In a sense, we've got two sets of risks. We've got the upside risks to the outlook posed in particular by elevated inflation expectations impacting wage and price setting behaviour. But we've also got continued normalisation in wage growth on the downside. And so, you know, particularly with the opening up of slack in the labour market. So I do see the central case, which is what we've got in our forecast 2 years out of inflation coming back to target, to be the most likely outcome. And although our short-term forecasts are quite mechanical for inflation, you know, they're based on what you can see in the individual components, the fact that those have behaved themselves this year in indicating that the hump would appear and then we remain on track for it to peak does give me some confidence, more confidence, that our medium-term forecasts for inflation are well set, although that's not to underplay the significant uncertainties around that. As I said, I think key to the disinflation process will be continued normalization in wage growth. We are seeing wage settlements data come in line. We have problems with our main official indicators for labour market activity, and a little bit on the earnings side as well. But our pay survey from a year ago that suggested wage settlements would be at 3.7% by the end of this year is on track. That's from the latest settlement data. And those are also then pointing to settlements being lower, say closer to 3% further out into next year, which will be getting down to target consistent rates. Although, as I've stressed, there are real uncertainties, and one I'll highlight, which is also relevant to the research agenda, is the world of supply shocks that we now operate in. And particularly for us in the UK, I think we're less certain about what's happening in the labour market, and particularly what's happening on the labour supply side. And I'll admit, from what I've said on previous panels over the last year or so, I've been surprised by how long it's taken for that wage setting behaviour to come back in line. So I don't rule out that there are more structural factors at play in our labour market. But anyway, taken together, for me, the risks to the inflation outlook in the UK are balanced. We'll come back to the research agenda, but the more support everyone in this room and beyond can give to helping us as policymakers understand those risks around central projections and what they might imply for different scenarios is vital. But as of now, looking at the UK inflation outlook with those risks to inflation balanced, I think the gradual and careful approach that the MPC has taken to removing policy restraint remains appropriate. And I see scope for further removal of policy restraint looking ahead. And I'll stop there.
Thanks a lot, Dave. I think we had time to print your second slide, where we see that in particular some of the salient prices, food prices, but also services inflation and rents are fairly high. So if I go back to the experience of the euro area, where real wages took time to catch up, so and we are still in the phase where real wages are catching up after going relatively deep in the negative. If you would apply the same metric to the UK, you could expect that there would be some form of real wages catching up in the pipeline. So maybe later you can come back to your assessment on these risks. Now we are moving to the second phase of this second round of intervention by the panelists, and after the third round, we'll open the floor for you to ask questions. So you can already take notes of questions that you want to ask later on, or you can indicate it for our audience online. If they want to ask a question, they can signal it through their device. So this is a research conference on inflation, and our understanding of inflation is, you can see the glass half full or half empty. If you want to carry on doing research on inflation, you want to see it half empty. But if you're a policymaker, you'd like to better your understanding of inflation for sure. So we'd ask now the three panelists to share with the audience, where we have many researchers and some of the best researchers on inflation that we have as of today. What is it that they miss? Where would they see gaps in our understanding of inflation? So we've had this surprise inflation, the largest in a generation, and the first true test of inflation targeting that most central banks through the world are going through, and inflation has come down close to 2% in most jurisdictions very rapidly after the spike in 2021, 2022, and disinflation since 2023. And it was very surprising. It was a surprise for most people in this room, for most observers, for most central banks. So with this recent history in mind, and given this audience, where do you guys see researcher, where should be the priority of researchers and economists who work on inflation? Where should they focus their attention? So we'll change the order, and Philippe has the floor first, and we'll go to Dave and then to President Hammack.
So I really welcomed this question since I know a lot of you spend a lot of time trying to decide what is the highest return research you can do. So maybe first point I'll make, even though it's not to my immediate benefit, I do think that this very large inflation cycle, the shock and then the disinflation, while it's still fresh in our minds, people should be still, I mean, there's been many papers written, but I don't think the last word has been said. So having really good documentation, really good analysis of this inflation cycle remains very important, even if I hope it's totally irrelevant for a long time. Because I mean, honestly, when this happened, I went back, I was reading QJEs and AORs from the 70s and early 80s, trying to find, okay, because that was the relevant material. A second one is, I think there might be a prize for someone who can integrate the low inflation before the pandemic, and then the spike, and then the disinflation. So having a unified theory of basically being below target for a long time before the pandemic, being above target, and now maybe, hopefully, re-anchoring at the target. I mean, I think this is it sounds, I think it's very non-obvious. It sounds common sense, but I think it's not obvious why it looks like there's a lot of anchoring around the target when we've been away from the target for so long. Okay, so then let me be more immediate, and this connects also to the strategy review we did this year, because the Eurosystem staff went through a lot of assessing, okay, what do we think are going to be the influences on inflation coming up? So the first point that I'm going to make before I get into it is it's very important to differentiate inflation volatility and, if you like, the persistent component of inflation. And this is going to be recurring quite a lot. In other words, what do we have to react to versus what can we say, well, we can't fine-tune inflation every month. If inflation deviates from target for a few months because there's a shock, maybe that's okay. But, guided by the staff research, finding out when in real time you can be confident enough to say we look through, versus in real time saying, okay, we don't know for certain, but maybe through a movement in inflation expectations, maybe through some other mechanisms, the medium-term anchor is at risk if you don't respond. So what I would say here is, we do say in our review, which we also said before, we think there's a lot of structural changes going on in the world. So whether that's demography, and let me extend demography to include the migration question, which is currently under discussion. It's automation, AI, digitization. It's geopolitics, and also it's changes in the financial system. And then the question is, okay, these obviously will have an effect on the trend behavior of the economy. Are they going to affect inflation? And then the question is, are they going to create inflation volatility, or will they matter for the persistent component of inflation? And here, I think going back, there's been a lot of related work done about, for example, news shocks and macroeconomics. Because if something's anticipated, it's very different than if it's a surprise. Now, Russia-Ukraine war was partly anticipated. There's a lot of discussion in autumn 21, very early 22 about the likelihoods, but it was a big shock. The pandemic was a big shock. But other times, well, actually, I'm pretty sure I know the demographic profile. Am I surprised that the non-immigrant component of the European workforce is shrinking in many countries now? No, because it's we've known this for a long time. Then the question is, okay, most structural changes have an effect on supply and also on demand. You were talking earlier on about low hiring, low firing. So the question is, because it sounds sensible, if lots of people are retiring, that means a tight labor market putting upward pressure on wages. On the other hand, lots of people retiring is going to depress demand, as people, no longer have the same level of earnings. So working out, again, using the standard macro about anticipated versus unanticipated, supply versus demand, and then the role of the financial system in intermediating, either amplifying or smoothing all of that, I think is important. Okay, let me switch gears to kind of modeling. And again, this partly reflects my own background in international macro. I mean, I have seen, and we have it at ECB, but there's examples elsewhere as well, of you might think the gold standard should be a global, multi-sector, multi-country model with lots of input-output linkages. And therefore, we can really understand how a bottleneck elsewhere can influence cost dynamics in Europe. Or an expansion in productivity. So if there's a big improvement in the AI capabilities in the US, how that might spill over to the US, to Europe. And there's a lot of progress here. But all I would say is, my bet is if you jump forward 20 years, we'll go back and say, well, that was real infancy. 2025 vintage was still in the infancy. So doing more to kind of integrate those kind of models, allowing for more and more in terms of the kind of nominal rigidities, realistic assessments of the demand side of the economy, realistic assessment of the non-traded sector, so we don't overweight the traded sector and so on. I mean, you were saying earlier on about the services. It's not tariffs, it's services. So
research techniques to an earlier period has become more and more important. And I think what I'd like to flag two related pieces of work which actually bank researchers have been working on. There was a staff working paper which actually grew out of the Cleveland edition of this conference last year, I think, by my colleagues Anestis, Asadi and Naylor. They find that during normal times, households are particularly sensitive to changes in food price driven inflation relative to other. It's good to know that these problems aren't just in the Bank of England. Universal. But that this sensitivity is much greater for positive and large shocks. And one of those authors, Naylor, has done some work with Verlander at the bank, and extending that work to more recent periods, finding the evidence that household sensitivity specifically to food prices has increased materially since the onset of the inflation surge. And I think that's very consistent with state-dependent dynamics. And I was struck by some of the posters over lunch that very much emphasize the research there, the sort of state dependency. And I think, that's why on the MPC, and also why I personally am putting a bit more weight on the risk that current food price shocks that we're having to deal with, although they may be global in origin, could generate second round effects. So I think that would be super relevant to kind of build on that very much kind of almost real-time analysis. And I'm really looking forward to the presentations that are going to be given in this afternoon's session. Second area, again, and apologies if this is a bit parochial, is maybe more so than the first, is structural. Actually, from what Philip's saying, I don't think it is. I think it is more universal. But I think the particular issues we're facing in terms of changing structures, there's one in particular I want to draw out, although I recognise, particularly when you think of the shocks we've been through, like Brexit and subsequently, how migration dynamics can affect through structural changes in the labour market, the inflation process. But the one I actually wanted to flag very briefly is that we've seen falling participation in the UK labour market relative to prior to the COVID shock. And that seems to be linked both to health-related issues, not just physical, but mental health, and also changes in preferences, such as early retirement. And those structural changes may well have implications for the outlook for activity in terms of supply potential of the economy. And also potentially on the, to Philip's point he was making, will they affect demand equally? But certainly in terms of, and this is where bank staff are focusing at the moment, are they changing, what used to, what we would have seen probably greater encouraged workers effects with people coming back into the labour market, particularly after COVID. Has that affected the contestability of the wage setting process? It's really a question for discussion. And of course, that's, as I said, a challenging time with the UK's main labour market evidence base, which means you have to draw on other sources. But, we'd be super keen to look at that whole nexus of issues and whether through the interactions of trend participation, drivers of participation, and factors that could affect the NAIRU, such as matching efficiency, does that give us a supply-demand disequilibrium that we didn't have before? Very finally from me, just to say something about the how of research, as well as what I'd like to see more in real time. And this does link to it being real time. I think it's really important. I mean, the world is so interesting at the moment with more, if I can use that phrase, with more supply shocks and with uncertainty about them, that I think research really does have to find a way, and I know this is on everyone's agenda, to be responsive to that. So yes, we need to be reading it in 20 years when we have hopefully the next big spike in inflation, but also trying to understand, helping us policymakers make sense of these supply shocks in real time, I think is important. And so trying to find a way to combine the necessary intellectual rigor with the needs of policymakers to be able to understand what is going on in their economies with more moving parts on the supply side than there used to be. Similarly, we policymakers have to be humble and show humility in recognizing the uncertainty. So we need to use that research judiciously. But I think, I would just encourage real-time research as much as is possible. And I hope that there's still enough interesting things happening in the world economy to mean that that you will see the returns from that research. And I'll stop there.
Thanks a lot, Dave. President Hammack.
So a lot of similarities in terms of the research agenda, and I think there's a lot of great ideas here. I'll focus on 4 different areas, and one area, to Dave, to your last point, that I've been particularly impressed on the speed with which research has come forward has been in tariffs. We went over a period where tariffs weren't a lot of discussion. Tariffs weren't a big factor in economic circumstances, and over the past 6-8 months, the amount of research that's been put forward on tariffs and their impact on the economy, on their impact on inflation, has been really impressive. And I think that's a place where we'll continue and want to continue to learn more about it. For the US, one of the big questions really is, are tariffs going to be a one-time price level impact, or are they going to be more persistent? And I imagine this shock will give all of you plenty of fertile ground for research over what it means if it's a one-time tariff versus it being layered in the way that these tariffs have been, the ongoing back and forth in negotiations. So I think there'll be a lot, of rich analysis to be done there. I also think understanding tariffs and their impact on inflation expectations, and I would say inflation expectations broadly is my second area of research. There's been a lot that's been done, and we saw some good papers this morning, mainly in the household sector on inflation expectations, but focusing more on firm inflation expectations. And so shout out to Ina, who's been doing some work in this area. I think it's been great to see more about how firms are coming to their decisions about where they're setting prices. I think that makes a a significant contribution to the field and to how I think about policy. Similarly, how short-term inflation expectations impact longer-term inflation expectations. And I would say, your point on food inflation certainly resonates with me. We've seen a lot of food inflation in the U.S., whether it was the price of eggs 6 months ago, the price of beef right now, how that plays through, not just in the UK, but in other regions in the globe, I think would be certainly of note. And then I will go back to the keynote. I was interested to see that there was a divergence between older people's experience of inflation and younger people's. And so some work around, does it matter, as we have this aging demographic, does it matter how recent that most salient experience of inflation was for inflation expectations, for how that feeds through into the economy, I think will be another area. The third one that I'll talk about is policy strategies. In the U.S., because we have to manage both sides of our mandate, we look at the misses and we look at the persistence. Our new framework that we just finalized says it will balance those two. Now, balance doesn't literally mean one for one, but understanding how should we think about those dynamics? How should we think about the miss? When I look at where we are today and I look at the miss on the employment side and that persistence, if you just take the SEP, you're looking at, a few tenths of a miss on the unemployment rate to persist for, 1 to 2 years kind of time frame, versus you look at, even if you just take the forward on the inflation side, that looks like that's going to be a much bigger number for a longer period of time. Do you just look at the integral, the forward integral of that? Do you factor in the historical misses, or do you ignore those? Do you weight those one-to-one versus one another? What's the optimal way to think about how you should set policy in those spheres? So I think that would be good work. And then the last one, which I know a bunch of work has already been done, but I don't think you can ever spend too much time, is on the unknowable R-star. And thinking about the neutral stance of policy. We're all trying to drive our economies towards our objectives. And one of the keys is understanding how far you are away from those objectives helps you to understand how much distance you need to travel. Right now, there's a meaningful, I would say, disagreement. You can see it in the dot plot that we put forward. There's about 200 basis points of range between R-star estimates in the U.S. And this harkens back to what Philip was talking about. We went through this period before the great financial crisis, where we had kind of 3 to 6% in the U.S., 3 to 6% nominal rates. There was a view that R-star was something around 2%. You go through the global financial crisis, and all of a sudden, whether it's due to productivity issues, regulation, other factors, you see that R-star estimates dropped precipitously, closer to about 0.5% to 1%. And now that we're coming out of the pandemic, is there something different? Are we going back to that pre-GFC experience and getting back to that similar inflation experience, productivity experience? What other things are driving it? Or are we going to continue to be in that kind of 2008 to 2020 type range of this very low R-star? How do we know that? We always talk in the U.S. about we'll know it by its works, but how do you see, where's the evidence that you can draw on that, and how do you bring that theory and practice together to get a good insight about where policy actually is?
Thank you. So a lot of work ahead for you. So I will open the floor actually now for questions from the audience, but I will still keep the privilege of being in this position to ask my own questions, and then we will take several questions and we'll see who among you takes which question. So first, some shameless advertisement for using a global model with multiple countries, multiple sectors to estimate the effect of tariffs on inflation. It's available in the latest quarterly review of the BIS. It's an article which is providing you with the answer, and I'm not going to give you the answer now. You can go and check it by yourself. Just to say that the estimates that we get may be a bit high for US inflation, because we assume that the effective tariff rate is 17%, which is like the announced weighted average of tariffs for the US. But effectively, if you look at how much tariff is paid to the US government, the effective rate is closer to 10%. But this may change over time. So that's first an advertisement, and then a question to to Dave and to Philip, which is related, because Dave, so you mentioned that inflation is in part this government tax on labor that feed to services, but why do they feed to services and not to goods? And also related to the interaction between monetary policy and fiscal policy in your latest conclusion of the framework review, Philippe. So the staff has this very interesting paper, occasional paper 371. It's 200 pages, but it's a lot of substance. And so there you show that fiscal policy did shave off as much as 1.5% of inflation in 2022. And then it comes back. So as a central banker, would you have preferred that fiscal policies do not interfere with stabilizing inflation? And can you elaborate a bit on that? But let me take questions from the floor. Yes, Beth.
Thank you very much for a great panel. One question on inflation expectations, which I think is of course relevant for all central banks here, but the situations may be quite different between the three of you. So on the one hand, in the UK, if you see that wage growth is still quite high despite a pretty slow economy, does that suggest that there is some issue with inflation expectations? In terms of the US, Beth, which between survey and market-based expectations, which do you rely on more and you think show better signals? And in terms of the euro area, are we going to get next year kind of worried about the anchoring to the downside because the projection is for inflation to drop below the target? So is that going to be kind of an issue on the downside again? Thank you.
Thank you, gentlemen here. Do we have another question from the floor to close this first round?
Yeah, thanks also from my side for a very interesting and very good panel. So maybe more a question to Beth in terms of how you interpret the relatively slow increase we have seen in US inflation after the tariffs. I mean, I think many people have thought it would probably have increased faster. I guess the question is it exporters who are paying the bill, exporters to the US, or is it more US firms? And is it just going to be delayed? Or how should we think about this conceptually? Thank you.
Okay, who wants to go first?
I can go first if it helps and your question as well, Benoît, as well as Beth's question. I mean, I think the point for us is that we are, when you look at the structure of our economy, it is kind of 80% services. We are a very service-heavy economy, and we also have very significant within that. I mean, we obviously have global services. We're the second biggest service exporter in the world after the US, but we have very significant retailing, hospitality sectors, and those have been a lot of relatively low-paid workers hit by particular, aspects or in terms of their employment of the national insurance contributions increase, as well as increases which were very much consistent with past and present government policy to increase living wages, up to 2/3 of median income. So I think the reason we focus on services more than goods is we just see it more prevalent, more apparent in that very large service sector, and also goods inflation. Once you take out food and energy, as my chart showed, has been broadly behaving itself. That may change depending on what happens, but that's not a kind of something we draw attention to in terms of either the inflation or disinflationary process. And look, on Beat's question, it's possible you could get those second round effects. My risk assessment is that is less likely. You know, I do see, in fact, the last time we were on a panel, 3 months ago, seems like a long time ago, but I emphasised, you know, the cumulative evidence of the loosening in the labour market. And although it took a bit of time to come through, that is now coming through into wages through this year, which I do see on a track which I can explain, you know, with how I think about how the labour market, you would normally expect it to operate as slack opened up because of the restrictiveness of policy. But you know, as I tried to emphasise, I'm not ruling out that there might be more structural factors at work that could mean that you get that, you know, that disinflationary process, which I've been quite confident in playing out via the labour market, does stall. And I think some of my colleagues on the Monetary Policy Committee put more weight on that risk than I do. And it's why I think there'll be a big focus on what happens to the settlements data. Does it continue to fall back to target consistent rates? Or do we see further inertia, rather like I think we saw at the end of last year? Do we see a new bout of that? I don't see any evidence of yet, which is why my risk assessment is balanced. But on the committee, that is a concern. And that's, again, comes back to, I think, analysing these structural factors in the labour market, depending on the characteristics of whether it's the UK or the Euro area or the US, I think is going to remain a super rich area for research.
Thanks a lot, Dave. So, Philippe, President Hammack, you have 3 minutes each.
Okay. What I said earlier on about whether what we just went through is for the filing cabinet, which would be relevant, you know, decades from now, but not immediately relevant. You know, I think there's an issue here about are we going back to a kind of phase of rational inattention? So in terms of tiny fluctuations, so we do have a shortfall in overall headline inflation next year. In the baseline, it's going to be 1.7. As I mentioned, that's a mix of non-energy inflation being around 2, and then energy inflation being still negative. One important factor is we do assess food inflations will be markedly coming down next year. You know, I agree with the assessment that there's lots of global commodity prices here, but there's also for food in general, it does connect to wage disinflation. It connects to lower transportation costs and so on. So let me mention, I mean, another reason why inflation next year we think is going to be lower is exactly a smaller contribution from administered prices. This is, by the way, where the Euro system has a big advantage over private sector, because we have 20 member national central banks in addition to people here in Frankfurt. I mean, at the peak, I may be wrong, and the staff can correct me afterwards, but we had hundreds of fiscal measures we were tracking, hundreds across the 20 member countries when the when inflation went up. And they're still rolling off this year. So there's a noticeable contribution to the upside, basically of reversing subsidies this year. Next year, that kind of dwindles away. So going back to Benoît's question about peak inflation being reduced, but the inflation episode being prolonged, I think that's true. So we did have this windfall of energy inflation coming down and being negative for the last several years. So the worst, maybe this is where you had it worse, which is basically, again, to repeat, non-energy inflation is still well above target. But with the energy deflation windfall, you know, I think being around target is a nice place to be. I'm quite attracted to the instability. My bet is a function of peak inflation. So anything that reduces peak inflation, there's a big reward, I think, to reducing peak inflation, even at the price of prolonging the above target episode. For me, I'm not. Again, for me, with the expectations, the inattention issue, I think, is relevant. But I do think going to the institutional set of the European labour market, the cost of living channel is relevant. So we know that essentially the wage settlement is a big factor is the lagged cost of living increase a year from before, 2 years before. And so anything that reduces increase in cost of living will be persistent via lower wage settlements. So if we have inflation well below target next year, it will have a footprint in terms of I think, lowering wage settlements, all else equal. And then demand levels. So the reason what I said, my bottom line on inflation is, I think it's plausible that we're going to converge to around 2. We're not going to have this plunge below 2. Is the support for demand in the European economy, which means that firms will be interested in maintaining price increases. It's there, I think, in terms of the recovery, the level of real wages will support consumption. We still have the interest rate sensitive sectors of the economy only starting to respond to lower interest rates. And we do have more fiscal support than normal.
Thanks a lot, Philippe. President Hammack.
Thank you. So I'll start with survey versus market-based measures. Yes, I like both of them. We pay attention to both of them. I think I take away different things from each, but I think it's important to look at all the information that's out there and try to collect that and understand where things are. And obviously, the different surveys will give you different insights into different slices of the population, whether that be firms, consumers, businesses, and putting that all together really helps. But the market-based measures, the thing that I take away from that is, do the markets believe that we are serious about our 2% of inflation objective? And if I see that drifting away, that says to me that the market might be interpreting us as being less serious than I am, or that we intend to be, about getting back to that 2% inflation target. So that's an important signal for me, just in terms of our ability to deliver against the mandate. On the impact of tariffs and why aren't we seeing more of that show up in the data? A couple of theories. It definitely has been less than I would have anticipated when the tariffs were first announced. There are a couple of things that I hear. It's not that it's exporters who are picking up most of it, although there are some cases where you see exporters are picking up some of it. Businesses pulled ahead their inventory accumulation pretty significantly in the first quarter. That's pretty transparent in the GDP data. And what we've seen is that businesses were slowly working through that inventory to get that out. It feels to me now, from my conversations with businesses, that they're largely through that inventory pull ahead, and that there may be a second round of impacts that we see coming through. The other is that the businesses have been trying to buffer consumers. They're worried because we've been in this environment of above target inflation for quite some time. They recognize that in the US, we've got this 2-speed economy going, where the top end of the wealth spectrum is doing incredibly well, is happy to pay any price increases, but the lower and middle income families are really struggling, and most of their paycheck is going to housing and food and gasoline prices, and they don't really have a lot of disposable income to spend. And so we have seen that businesses have been more cautious about passing on some of those costs, and they've been trying to absorb some of it. From my discussions with businesses, that's not going to last forever. They're going to have to start pushing that forward. And so that's another place where we could see it coming through. And then the third one is really around the collections. What we've seen is, as Benoît noted, you're seeing a headline rate of something around 16 to 17%, but the collected tariffs are closer to 8 to 10%. That could be enforcement, that could be transfer pricing amongst businesses. My guess is the longer that the tariffs are in place, the more that bleeds in. And so you could see, again, more of these impacts flow into it, which, again, we can talk about, is it transitory? Is it more persistent? If it's transitory, but it takes 2 years for the full impact to come through, is that transitory? How do you think about that in terms of what that's going to do to individuals, businesses, inflation expectations, and their experience, and what that flows through into the growth outlook?
Thank you very much. So a lot of food for thought and ideas. Where your research is in high demand, and so I'm very much looking forward to the papers that will come out of you listening to our 3 speakers who deserve a round of applause.